Let's get a fundamental view. Let's zoom out a little bit and let's try and see how Manish Gunwani, CIO Equity at Bandhan AMC, is looking at markets. Manish, great having you. Manish, let me start off by trying to set the context with regard to earnings, because at the end of the day, markets are a slave of earnings. We've seen an earnings revival come in. Some of that was, there was a lead on the earnings revival to a large extent because of the labor code adjustments that played out. But the essential question that markets will ask is, can it sustain? And can we start to see an earnings upgrade cycle start to kick in? And how far are we from that? Really, that's the question. Where do you sit on with a view with regard to that?
See, from a top-down perspective, FY27 should be better on earnings because of 2-3 things. One is that the nominal GDP will pick up, partly because inflation will go up. So we kind of bottomed out nominal GDP at 8-9%. I think it will be 10-11% going forward. And corporate earnings obviously have a decent correlation to nominal GDP. Two is rupee depreciation. See, rupee is depreciated not only against the dollar, but a lot of Asian currencies as well. Rupee depreciation is good for earnings. So whether it's pharma, IT, refining, oil and gas, whatever, all that benefits from rupee depreciation. So at an overall basis, earnings should do better. However, I must say that recent market action is not about earnings, because I think globally everyone is trying to grapple with the effects of AI. So if you see, it's not that IT earnings have been knocked off in the past 2-3 weeks, but I think the terminal value of a lot of businesses is under question. So to my mind, at least in the near term, that is a bigger question rather than earnings, honestly.
Okay. And Manish, in terms of the revival, so say FY27 is that year where we start to see a revival. Point taken, plus the lower base will likely help. Talk to us about what are the sectors which will likely lead that earnings uptick or revival, because one would want to understand whether we've already seen an uptick in terms of stock prices in those sectors, or are they looking ripe to probably take opportunity from that revival?
So, as I said, since nominal GDP domestically is picking up, I guess the domestic sector should do better, banking, and whoever is either an exporter or import substitution or pricing of dollars. So, for example, whether it is pharma, IT, refining, metals, all those sectors should benefit from the fact that they effectively have a lot of dollar earnings. And today you're converting that at, let's say, 1991 rather than 86, 87 1 year back. So I think so it's going to be pretty broad-based to my mind. As you rightly pointed out, last 1.5 years, the base of earnings has also been pretty weak because we had low nominal GDP, banks had pressure on NIM. So all that should play out. Even something like telecom, if the expected tariff hikes happen, then the earnings should play out. So I'm not, honestly, I don't think earnings is driving this market right now. As I said, I think the whole global market is trying to grapple with what are the sectoral impacts of AI, and if it starts from IT services, does it mean that will there be a broad-based slowdown in India? Because obviously IT services is the biggest export sector we have. So that's my view, basically.
Manish, where do you sit on where that argument is concerned? Do you believe that the AI impact on, and I'm not just talking IT, I'm talking about the overall market. Yeah. Is it overdone? I'll come to IT because that's really the golden question and I want to take that separately. But with regard to the market itself, tariffs, AI, really that's what's keeping a lid, right, on confidence. Do you believe that that's overdone?
It's a spectrum, right? I think obviously BPO, application development, infrastructure managed services, all that has been disrupted. So direct IT services, I am not very bullish at this point of time. The next layer is GCCs. I am at this point of the view, based on whatever data is coming, that GCCs will still do well. And hence the broader economy in India will still be okay. Now, having said that, we are living day by day. So one needs to be nimble about this. But right now, I am kind of positioned on this framework that while coding, BPO, application development are disrupted, uh, I think India has a lot of economic momentum. We have decent macro stability. We can stimulate the economy either through fiscal or monetary means. And therefore, I'm still not of the view that Indian economy is structurally disrupted.
Okay. And IT in particular, Manish, I know you covered some bit of it, but talk to us about IT in particular. You believe that some of the large traditional IT companies, as well as some of the mid IT companies, which are also now 50, 70,000 crore in terms of market cap, so they are also quite large in relative terms versus some of the other sectors. But talk to us about this entire IT pack. You believe that there's going to be severe disruption? Are the winners going to be skewed? Is it going to be a bell curve where there's going to be very, very few winners? How should one look at this?
No, obviously, on hindsight, we will find some companies doing much better. Question is it possible to differentiate those companies adjusted for valuation? See, some of these companies are obviously growing faster today, but then they're also valued like that, right? So as a stock, out of 10 IT services stock, will there be a differentiation in next 1 year? Obviously, there will be. But is it honestly very easy to pick the winner stock? I'm not saying the best growth company. Is it very easy to pick the winner stock? I think it's very difficult when it's such a sectoral disruption that is happening. Um, I think as a stock or as a sector in the market, the risk reward still doesn't look very great because obviously, as I said, within IT services, there are certain sectors like application development or BPO which are obviously disrupted. The second is you see a lot of global stocks with similar business models which are much, much cheaper. So I don't know why foreign investors will be in a rush to buy this until globally this sector turns around, right? And I think one of the markers for that will probably be a big acquisition of IT services player by private equity with G listed, or a massive buyback program by one of the bigger IT companies globally. At this point, we're not seeing that. Um, so I would kind of sit on the sidelines on core IT services stocks.
Point taken, Manish. Let me also try and get a perspective about some of the other forces that are playing out, at least on Indian markets. One is this entire theme around FII selling. Does that reverse, you reckon, in 2026 calendar year? And if that were to happen, what would the trigger points of that be? Give us a sense of that.
Yeah, so I'm a bit more optimistic right now on foreign flows. One is the rupee has taken fair amount of beating, probably the worst performing major currency in last 6 months. And for me, the rupee is a big trigger. Even if IT services is disrupted, but if you see the monthly data on services, which includes GCC and all other things, that still seems quite strong. So it's not like our current account is under stress. Now, our capital account's been under stress. One is just because foreigners have been selling. but also because Indians have been buying a lot of gold and silver. Now, my gut feel is that the recent volatility in gold and silver prices will cool down this massive run rate. Last 4 5 months, there's been um, uh, absolutely huge amount of buying of gold silver. Right, I think the last 1 month the gold silver prices have behaved in a very volatile manner, which should cool down some of that euphoria, and therefore our capital account also will stabilize. Thirdly, if you look at dollar, I think both from hard numbers, the current account doesn't seem to be coming down. The fiscal will again be under stress if these tariff refunds happen. So I don't think the dollar is fundamentally a very strong currency, and therefore uh, there should be flows out of US assets, which should benefit emerging market and which should benefit India as well. So overall, whether it's debt, equity, FDI, I do think that the prospects of getting foreign flows look much, much better at this point of time.
And if those flows are to convert, Manish, what are the sectors? Because if you're saying that global IT is, and I'll tie this up with your IT answer. If you're saying that global IT is valued at a much better price versus Indian IT, and IT is a big sector in terms of FIIs coming in. In fact, FII ownership in IT has shrunk quite sharply over the last 12 to 18 months. How should one therefore position themselves in terms of portfolio allocation? Where will the FIs actually come in and buy?
So one is, look, I'm not saying there is absolute downside in IT stocks, but yes, I don't see FIs buying that because there are better options globally. So the natural corollary to that is, see, if a country's biggest export is suffering, it's good for the second biggest export because the currency is obviously becoming more and more competitive versus, let's say, Chinese yuan. So, for example, manufacturing, I think there is option value that manufacturing may do very well because um, it is quite feasible that on a multi-year trend, yuan will keep appreciating against the rupee, right? And that is a possibility. That's a strong possibility, according to me, which is going to benefit manufacturing. Uh, the other thing is, of course, looking at domestic stocks, which look attractive. I guess banks, they're good beta. They may not give very high absolute return, but I think private banks have done nothing much last 3 5 years. I think they are good beta to own.
So private banks, and within that private banking pack, would it be the larger private banks? Would it be the mid, small? Because again, the larger ones are also trading at a large
Yeah.
discount. How should one look at that?
I would go for the cheaper ones because I do think asset quality is not going to be very different across banks at this point of time. Typically, asset quality is an issue when credit growth has been very strong last 3 4 years, or there is macro stability. I don't think we have either at this point of time. I think large PSU banks, the cheaper private banks, are probably what I would prefer rather than the top two, three high quality banks.
And Manish, you hinted at the fact that gold, silver, not a good time to buy at least at this juncture. Uh, uh, what would you tell, for example, an investor who's doing an SIP in gold and silver? Would you continue SIPs, or is it at a level where you'd say halt your SIPs as well? Just wait and watch, because you
No,
could
no.
you could well see a correction here.
No, I am a believer in the debasement trade. So I think people should own all risk assets, but we should always calibrate a bit based on valuations. So now that gold and silver obviously have done very well over the last 2 3 years versus Indian equities, I'm not saying make gold and silver zero, But I think there is a fundamental case to shift some part of gold silver exposure to Indian equities.
That makes sense. And Manish, within Indian equities as well, is it the large caps that are going to outperform? Given everything that we've spoken about, is it the large cap basket? Is it the mid and the small cap basket, which has languished for now almost 18 months? Is that basket looking better in your opinion?
Yeah, we believe we probably are close to the end of the underperformance of small caps over versus large caps. On a 2-3 year basis, I think there are a lot of small caps which either look cheap or have better growth, or in recent context are free of disruption. So I think a good small cap or thematic like innovation or financial services is better for someone who has patience. I am not expecting the market to run away because the supply is also very huge. We have NSC, Geo, a lot of big IPOs coming. So it's not like, while I don't think absolute downside is much, but I don't think market is going to take off vertically. So you need to have 3-5 year kind of perspective. But if you have that, I think the smaller funds with smaller companies may probably do much better.
Manish, I'm curious to know, and that's such a pertinent point you made, that just the quantum of supply that will likely come will take care of all of the flows that are coming in, whether it's FIIs or DIs, because that quantum of supply is going to be large. So point taken. Let me also try and get your view with regard to some of the platform companies. And we're at a point where we've seen a bit of a consolidation within that space. Are you bullish with regard to platform companies and the valuations that they currently trade at? Would you be selective? Would you just buy the basket approach? How should one play that?
Yeah, I'm probably more positive on platform companies than pure IT services companies, although I think globally they've also been hammered down in this AI uncertainty. But intuitively, I do think that the code is actually a very small part of a software product or an internet platform company. So the ability to generate code at virtually zero cost is a bit of pressure point, but whether it's enterprise or customer facing platforms, their main value is actually trust and reliability, not the code that works. So I'm a bit more positive on platform companies. I also feel that even if there is a bit of disruption, so if you buy the leader, I think a lot of the smaller platforms will obviously face even more pressure and may die out because a lot of them are loss making at this point of time. So it may also lead to faster consolidation, which eventually will lead to better margins. But having said that, as I said, we live day to day. If agentic AI seems to replace platforms massively, which is not my base case at this point of time, but if it does, then you have to be nimble about this.
Manish, it's been a great conversation. We've covered lots of facets of the Indian markets. Thank you so much for coming in and speaking with us.